SN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
And welcome back. You're listening to the Financial Survival Network. It's Kerry, Lutz, and with us is John Rubino of dollarcollapse.com and co-author of The Money Bubble. And John, so latest on Greece, I think you summed it up best, why there's no political fix. And when there's a crisis, a worldwide crisis, how can there be a political fix? I mean, the political fix is war, basically. War is the fix when politics fail, right?
Yeah, well, the crucial thing to understand about the whole world right now, Kerry, is that when you borrow too much money, you lose the ability to fix your situation. You just have to go through some kind of hard times. And Greece is a perfect example of that because they elected anti-austerity people now because austerity was a catastrophe for them. You know, their unemployment rates are through the roof and youth unemployment is 50%, yada, yada. Everybody knows those Greek statistics. And the guys that have come in are anti-austerity. They want to renegotiate their debt so it's less onerous, and they want to restore the cuts in public sector spending and everything. But because they're coming from the left, their solutions are basically the things that got us into the trouble that we're in to begin with, which is massive government spending and really stringent labor laws where it's impossible for companies to fire somebody once they've hired them. Therefore, why did they hire anybody in the first place? You know, and so their ideas, though it's refreshing to see Greek battling with the eurozone and standing up to these bullies from Brussels, right. Their solutions aren't actually fixes. They're just going to go back to the old way of doing things, which inevitably leads to some kind of a currency crisis. You know, excessive debt, which leads to excessive debt monetization, which leads to a currency crisis. So that's the Greek trajectory. And if they pull out of the eurozone, which is definitely on the table, you know, it's a bargaining chip that they're using right now. And if they do, then they see a massive capital flight, which they're already seeing. You know, people are going to pull their money out of the Greek banks because they know that the euros in their current bank account will be converted to drachmas and then devalued by 50%, because that's the left's way of dealing with currency issues and excessive debt. You devalue your way out of it. In other words, you inflate away your debts. And nobody wants to hold euros at the beginning of that process, right? So all the money in Greek banks is now flowing into Germany. Right. And so that's one scenario. The other scenario is that the newly elected Greek leaders cave to the eurozone and accept some form of continued austerity, which means they're in depression for the rest of their adult lives. There's no way out of this if they've got all this debt, and the only way they can deal with it is by cutting back on government spending and impoverishing their citizens. So there's no way out of this. You know, there's no set of political policies that make Greece and the eurozone a happy, sustainable place going forward. It's just not possible. So take this situation and extend it to the rest of the world, and you basically have the global economy. You know, everybody's borrowed too much money, and everybody faces the same set of choices. We can scale back on government spending in order to try to balance our books, but then we have a depression. Or we can try to inflate away our currencies in order to make our debts less onerous. But then we have rising inflation and greater instability, and possibly the Austrian economics crack-up boom out there. And that's it. That's all we've got to work with now, because after a certain point, there is no political solution to a crisis that is derived from excessive debt. So welcome to our decade. You know, that's what we're going to have to live through one way or another.
It's remarkable. You think about it, that they're going back and trying to just print their way out of it effectively, the Germans, and they can't. I mean, the Greeks, rather. They're trying to hire more people, right? And trying to, pay government workers more money. And, what's the result of it going to be?
Well, it's true that they are doing the print your way out of your debt strategy, except that they can't print.
Right.
You know, they can't make new euros. Only the European Central Bank can create more currency. Mm-hmm. And so Greece only has one half of the tools needed for that kind of a strategy. They're using the same currency no matter what. That's going to, be valued where it is, regardless of what Greece does. And all they can do is increase their own local spending and their own borrowing. And that won't help them. All that'll do is just force them to go to the debt markets at higher and higher interest rates, which is what's happening right now. They're borrowing money, but they're having to pay more for it because nobody trusts Greek debt anymore. And so that's going to increase the interest cost component of their budget and make their deficits even bigger, which requires more borrowing, et cetera, et cetera. And so that's where they are. There's no solution.
Yeah. So the same thing that caused the situation, they're resorting to failed policies that are just going to deepen the crisis, make it worse, right?
Yeah, as are we all. It's not just Greece. Greece is the country that we're watching right now because it's kind of under deadline, but everybody else has the same problems. And the U.S. chief among them. We borrowed too much money. We have no choice now but to either inflate it away or accept some form of a depression in order to get rid of the debt through default. And that's it. So as goes Greece, so goes the rest of the world in the coming decade. So that's why Greece is so interesting. Otherwise, it wouldn't be. It's too small to really have a direct impact on the global economy. It's just some little tiny fraction of even just the eurozone's economy. But it's an indicator of the road that the rest of us will have to travel in the next few years.
Yeah, it's a bit scary. And when you see the riots they're having there and all the social unrest, you realize that we'll have the same, won't we?
Oh, completely. I mean, once the true nature of our unemployment becomes public, for instance, we're in the U.S. reporting really good headline unemployment numbers, 5.7% or whatever it is. That's normal, quote unquote. That's going back to the 60s and 70s, back when the economy wasn't overburdened with all this debt. That's the kind of numbers we put up. However, if you look at a more realistic measure of unemployment, which is the percentage of the working age population that's actually working, it's depression level. It's up in the teens because so many people have dropped out of the workforce in the last few years. And they don't get counted in unemployment because they're no longer looking for work. So they're not in the workforce. But they would work if they could. They just can't find jobs. So, we're in much worse shape here than the official statistics show. And eventually that reality is going to dawn on people, because on Main Street, it's just not as good as the macro numbers make it seem. And so, people could be very frustrated here if they understood the truth, and gradually they'll figure it out. You can't hide reality forever. And so when we figure out that things are more or less here like they are in Greece and Spain and Italy, and they're only getting worse because we continue to borrow more and more money without making any kind of structural changes that would lead to higher employment and more trade, things like that. You'll see us in the U.S. start to lose faith in the guys running the economy, and things will get harder and harder for them to keep hiding the truth. So it's coming. Yeah, And some other interesting stats just came out lately too that show how things really are in the global economy. For instance, China's exports to the rest of the world just plunged lately. And the reason for that is that their currency, the yuan, is more or less pegged to the dollar, which means it has gone up dramatically relative to the currencies of Asia and Europe, which are big export markets for China. So Chinese exports are way down. And so they reported a really good trade balance. They had a big trade surplus just lately, but it wasn't because they were selling lots of stuff to the rest of the world. It was because they're exporting less and importing way less. Their economy is shrinking, and that gave them a better trade balance, but not for good reasons. And at the same time, the Baltic Dry Index, which is the rental cost basically for big container ships, is at the all-time low now. It's been low lately, but now it's the lowest it's ever been. And that implies also that global trade is starting to contract because we don't need so many ships to carry goods across the sea. And those are indicators that the global economy really isn't growing. We're not recovering. we're actually shrinking. And so we'll see how that plays out in terms of GDP for these countries going forward. But it's a really disturbing sign at the moment, when exports are falling for the biggest exporting country and when shipping rates are tanking, that's usually a sign that the global economy is starting to contract.
Not a good sign at all.
No.
And you know what's going to happen. So we've seen this many times before. There's nothing new under the sun, as has been said before. And you just know what's going to happen here.
Yeah.
Not good. And what do? That's the question.
This is amusing to talk about. It's fascinating to watch it all play out. But for an individual, we can't change any of this stuff through the political process. It doesn't matter who we vote for. The big systems have institutional momentum right now. They're heading for that cliff. No matter who's in charge, no matter what we vote for or don't vote for, it doesn't matter. This stuff is all going to happen because there are no political fixes that are on the spectrum of what's possible. It doesn't matter whether we elect the left or the right or the center or some combination thereof. They're all going to more or less do the same thing. Military budgets are going to be big in the U.S. We're going to be intervening around the world and causing more problems than we solve. We're going to be borrowing more and more money. And we're going to increasingly intervene in markets and short circuit the pricing mechanisms. So we don't get any signals from markets anymore that tell us how to allocate capital. All of that is going to continue. And therefore, our problems, which are due to those things in the past, are going to continue to increase. It's just going to get worse and worse. And so in the short run, it's more of a catalyst watch. It's, what's going to blow up first and what's going to take down the rest of the system. And you're seeing Greece start to have an impact on the other peripheral countries in the eurozone, for instance, bond spreads. Which are measures of uncertainty in various countries, are starting to rise for Spanish and Italian government bonds. In other words, those countries are beginning to have to pay more and more to borrow because people are looking at Greece and saying, well, all right, they're toast, but who's next? And Spain and Italy are prime candidates. So now people don't want to lend to Spain and Italy because the thought is that over time, as Greece works itself out in some kind of really suboptimal way, that the same kind of problems are going to bubble up in Italy and Spain, and the same solutions are going to end up being offered. In other words, they're either going to accept ever greater levels of austerity, pushing them into a depression, which causes all kinds of trouble, or they're going to have to leave the eurozone. And either way, that's bad for local bond yields. It's bad for Spanish and Italian paper. And so people are starting to worry now after being willing to lend to these guys at extraordinary low rates for the past year, lower than what the U.S. had to pay to borrow. Interest rates are starting to go up there. So let them continue to go up or let them really spike in a short period of time. And you get turmoil in those countries too, as well as in Greece. So it just goes on and on. As you tease out the different threads of the global economy, you find problems everywhere. We haven't even talked about Japan, which continues to borrow insane amounts of money and continues to have its demographic problems get worse and worse. The population is shrinking at the same time that the debt is soaring. So at some point, those lines cross and the system doesn't work anymore. And the point seems to be fairly close. So Japan, if the eurozone, by some miracle, gets its act together in the next couple of years, the focus could shift to Japan. They could be the epicenter of the global crisis. There's no way to know who's going to blow up first, and there's no way to know when it happens. But it's fairly certain that something very serious is coming down the pike in the not-too-distant future.
Yeah, we know that. We know that's for sure because it's just not improving, right?
Well, no, we're doing all the same things that we've done for the last 30 years that have caused the problems in the first place. We're throwing newly created currency at our old debt in the hopes that somehow more debt will solve the problems of too much debt in the first place. And that's not how it works. That's if you lost your job and decided to maintain your lifestyle by putting it all on credit cards, you'd look fine to your neighbors, but you wouldn't actually be fixing anything. And that's what the world is doing right now. We're the family down the street that has an SUV in the driveway and a 4,000 square foot house and a big screen TV. But now they're putting it all on credit cards. So the repo man is coming. You know, they're going to take that SUV and tow it away, and they'll take the TV set one of these days, and then they'll foreclose on the house. And that's all coming, but you don't see it now if you're one of the neighbors. You just see the nice stuff right there. And that's the world. You know, that's the U.S. We have this amazing military budget, or, you know, global empire, really, that we can beat anybody else in the world or any combination of anybody else in the world in a fight right now. But it's all paid for with debt. We're borrowing basically from China to pay our military budget.
Yeah.
And that's unsustainable. So we look great now, but in another few years or another few months, who knows?
Who knows?
A lot of the truth is going to be revealed, and then all of this will be seen to be an illusion bought with debt.
Yeah, that really is it. An illusion bought with debt. I couldn't have said it any better myself, John. And you know what happens to illusions, don't you?
Well, they disappear eventually. You know, the truth comes out, and you know, that's coming. It's amazing how long they've been able to keep it going, though, because everything we've said today, without except for maybe the Baltic Dry Index, everything else was true a decade ago. You know, there was too much debt. They were throwing newly created currency at the debt, and interest rates were doing strange things, and trade balances weren't what they should be. All of that was true a decade ago, and somehow they've been able to keep it going by printing more currency and borrowing more money and all the things that we're talking about today. And it's kept it going for a decade, but at a cost of maybe another $100 trillion of debt right now. You know, the statistics on what new debt we're taking on bounce all over the place, because it depends on whether you count unfunded liabilities or whether you're looking at just government debt or government private sector debt or whatever. But the numbers are gigantic, however you slice it.
They are staggering.
And so, in effect, we've maxed out a bunch of credit cards in the last decade. And so we maintained our lifestyle. But now we've got a whole bunch of credit cards that are ready to step up from their teaser rates to 19% or 22% or whatever they go to. And when that happens, everything blows up. So the analogy, as you apply it to the bond markets, is that interest rates start to rise because nobody wants to lend money to Italy for 10 years at 3% anymore. You know, they want 7 or 8%. So all of a sudden, the Italian budget blows up because their debt costs are through the roof.
Exactly. Same
thing with Japan. Same thing with U.S. It'll happen somewhere, then it'll spread to other places, and then the governments of the world will have to be creating so much new currency to push down bond yields that the problem will shift to currencies. Nobody will want to hold our currency anymore because they see what we're doing in order to force down bond yields in the face of market resistance. So that's one scenario for the system to blow up. There are many more scenarios.
Yeah, there's a lot of different scenarios. On that note, got to get going, but you find John's work at dollarcollapse.com. Don't forget, check out his book, The Money Bubble, that he co-wrote with James Turk, and all can be found on financialsurvivalnetwork.com. And John, we will see you next week. Thanks.
Great. Thanks, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.